Hey everyone, hope everyone's doing well. This is the overview of the Emini for Wednesday, October 2nd, 2024. Here's the daily chart. Coming into the day, we had this big outside bar. It's a bear bar, but there's big tails, and again, it's an outside bar, so expanding triangle. We know the market's in a tight trading range up here. We know the market is in an overall trading range over the past many bars, big down, big up, big down, big up, and lots of overlap here. And I kept mentioning that at some point up here, when the momentum disappears, the trader's equation gets really bad for the bulls. Let's say you're buying and you have a wide stop at the bottom of the bull trend, and let's say you're long, and you can see 1 to 1. One times your risk is all the way past 6,000. And that's a problem because you need to be 60% sure that the market is going to your target in order to risk what you're going for a reward. And when the market starts to go sideways and you see the market is at the top of a trading range and 80% of breakouts fail, you know there's not a 60% chance we're going here. There's probably not even a 50% chance we're going here before here. So at some point, the bulls start to give up. And we had a little bit of profit taking here. But I kept saying we probably would come back and test the daily chart moving average, which is here. And we got so close to it yesterday. And again, yesterday being bear bar, we'd probably either break out below the bar or above the bar, but we closed in the lower half of the bar. So I thought more likely we would go below the low of the bar and see what was there. But because we haven't touched the moving average in many bars and it's a tight bull channel, I suspected there would be buyers at the moving average. Even if the moving average wasn't here and you just think about the bars, tight bull channel going sideways, outside bar, we know that this, even though it looks like a trend bar, we look at the 5-minute chart and it's clearly a trading range. So just from knowing that alone, without this moving average, you know the odds were there would be buyers below yesterday's low. So this blue line is yesterday's low. And for today, we had a gap down and 3 decent bear bars on the open. But the sell-off wasn't as good as it could have been for the bears. You have buyers into the close of bar 1, tail above 2, tail below 2. So again, buyers into the close. So if this is such a strong bear breakout and the bears are desperate to get short, then why is there buying into the close of this bar and this bar? And why is the strongest bar the last bar in the sell-off after, the sell-off may have started from bar 61 yesterday? This is climactic, and it could simply be a second leg down. Leg 1, pullback. Leg 2. Again, the blue line is yesterday's low. We're expecting buyers below yesterday's low, and you can see one bar broke below it, but the bears did not get follow through. So you can see the reaction. The bears try to get a breakout on bar 3. They want follow through. So far, it looks good, but then you get bar 4. And Al has a general rule that 50% of breakouts on the open will reverse, no matter how strong they are. And when you factor in the context, this bear breakout may not have been as strong as it appeared to be. So big bull bar on 4. You could buy above bar 4, but big down, big up. There might be sellers above bar 1. Really not ideal buying above 4, but it's probably always in long and okay to buy above 4 for a swing. But if you do buy above 4, look at your follow through. You go sideways for 2 bars, you get a climactic bar on 7, you go sideways for more bars. It's really not ideal. and potentially we have a spike in channel, and in this case we channeled all the way up here, but here it may have been leg 1, maybe bar 5, leg 2, 7, leg 3, 11, and then you can see we got a deeper pullback. Good for the bulls that we have an open gap. There's a body gap from the close of bar 11 and the close of bar 5, or you could say the open of 6. These bear bodies do not overlap, and that's a sign of strength for the bulls. But look at the context to the left, and you just ask yourself, is a strong bull trend likely with all of this trading range price action? Probably not. This is the major high that the bulls need to get above to start convincing traders that this could actually be a strong trend. Until the bulls get above here, all of this could simply be a pullback from this bear leg. So a bear breakout, deep pullback, and then the bears, this breakout should still get a second leg down. So all of this could be minor because look to the left. So we have this bull trend, but there's a couple of other problems with this bull trend, and let me just add one thing. Whenever you have a breakout and it fails, the market typically tries to reach the opposite measured move. So using the bodies of bars 1 through 3 projected up, that goes here, and you can see that's actually really close to the bar 72 low yesterday, which was a bad stop order sell signal bar, which got good follow through. So that's another magnet. The market typically closes gaps when it's in a trading range. So here's a potential magnet. But going back to what I was saying about this bull trend, when you think about how small pullback trends behave and small pullback trend days, you typically don't get 3 strong bear bars on the open. And on top of that, you typically do not get these big bear bars along the way, bar 11 and bar 17. And at this point, the bulls were no longer keeping gaps open. Bar 17 closed below this bear body. So we're getting more overlap. The trend is weakening. Up here, you could see 3 pushes, 1, 2, 3. And maybe that even subdivided here, rallied up to 25, pulled back, rallied up to 27, pulled back on 28, rallied on 28 and 29, and then reversed. So we might get 2 legs and 10 bars sideways to down here. And let me just touch on one more thing before I go on. When you think about the trader's equation, and there's this target above this red line, the bar 72 low, you always have to be asking yourself, how much am I willing to risk and how much do I stand to gain? So if you have a stop here, let's back up a little. You have a stop below bar 19. Let's say you're long on the close of 27. If this is your target, the bar 72 low, then you're risking about, maybe 6 times what you gain or what you stand to gain. And if you're going to do that, Al talks about that I think he talked about it in the course, or he maybe talked about it in a YouTube video or the webinar. But I remember he talked about this ridiculous trader's equation where, if you think about it, I think it's in the course. If you think about any trade, let's say over here, 53, 54, breakout and follow through. So you buy the close of 54, 60% chance you get a measured move. When the market's here, and it looks like it didn't quite get there on this bar. So somewhere in here, if you're risking all the way down here, and at some point your target is just 1 tick away, let's just look at it. So 29.75. You're risking almost 30 points to make one tick. And if you're risking 30 points to make one tick, you better be, 99.99% sure that the market is going to your target. Otherwise, you could never hold on to that trade. The risk is just way too big for the reward. And that's an extreme example, but that's the point I'm making here. The bulls, maybe their stop is down here. And, even if their stop is here and you're trying to get here, you're still risking maybe 3 times your potential reward. And just look at the price action. Big down, big up. We're starting to get a lot of overlap. At some point, it's not worth it for the bulls to hold on to the trade. And they start to take profits, and they decide that they'd rather buy lower. And the bears, they think about the opposite. So let's say, if you had to choose between buying the close of 27 or selling the close of 27, so if you're buying, stop below bar 19, or if you're selling, you put a stop way up here. Which would you rather do? And it's really helpful to think through really every tick in that way, because trading is all about math and the trader's equation. And if you're not 60% sure that the market is going 1 times your risk, and your risk is the market price to your stop, if you're not at least 60% sure the market is going to your target, which is 1 times 1-to-1 equal to your distance to your stop, then you cannot be in the trade. 60% is the minimum for 1-to-1 risk reward. So we start to go sideways here. Very tight trading range, possible final flag. It's a triangle. And it's not clear to me that the bulls are in control here. Even though we have a lot of bars up, we had a lot of bars down here. So again, big down, big up. The market's in a trading range, and we might be in the upper third of the range. We had a bad buy signal bar 3. That's a magnet. The market's going to want to come back and test here. But I suspect if we do come back and test here, there will be buyers waiting down here. And we just back up again. Right here, we have it's a nested wedge, a couple of different ways to count. 3 pushes up, and then we get 2 legs here. 1, pull back, 2. But this is only about 6 or 7 bars. Is that enough to correct all of this? Probably not. So in reality, this all might be just 1 leg, and then we may get a more complex pullback, and then a bigger second leg. So 2 legs down, deeper pullback, and then we started to get a bigger leg down, and this could all be seen as a fairly tight bear channel, so not ideal for buying a bar like 41. Small bull bar, first reversal, tight bear channel. You can see nobody was interested in buying there. Now, an important price level is a 50% pullback. So, sorry I'm all over the place today, but let me back up one more time. We think through yesterday's chart, or even if you just think about the daily chart bar, and here's the high, here's the low, and I'll extend this to the right. The red line is the midpoint of yesterday. And look what happened here on bar 17. The market's rallying, but consecutive buy climaxes, we get really close to 50%, and then there's a lot of selling. Whenever you get close to sort of an obvious magnet, the odds are it's typical to see the market pull back and then actually reach the magnet. Plus, this is a tight bull channel, so even though bar 17 is a strong bear trend bar, Just look what happened on bar 11, or just look what happened on bar 3. Bear bars are getting bad follow through. Tight bull channel, only want to look to buy. You can see the reaction when bar 22 actually reached the midpoint of yesterday, sellers. And you can see we had a really hard time getting anywhere through there. So another point about 50% pullbacks, look at the 50% pullback of the rally today. And you can see where the market found support. If I extend this to the right, you can see that's just about exactly where bar 50 tested today. So we rally all the way up. And I mentioned down here, there's trap traders, bad buy signal bar 3. But again, think about the trader's equation. So let's say you have a target here. So maybe you see the rally to the midpoint of yesterday. And you say, I don't know, there's a lot of overlap. It's consecutive buy climaxes. It's probably a trading range day. And that's all accurate, and that's fair to say. But this is really far away. You can see what happened. Down here, we had buying and follow through. So I don't know if we'll get all the way down here. We have to watch the price action. So let's say you sell and you put a stop above bar 28. And let's just say you're short. You get bar 42. And your stop's up here, you're short here. All of a sudden, your 1-to-1 target is past the bar 3 high. Is there a 60% chance we're going here before here? I'm not sure. It's not clear. And that brings up the 50% pullback again here. Here's 50%. 42 came close to it. We'll probably get there. But if we do get there, there's probably support. That's because of trap traders. That's the point I'm making with this red line. You had bears who sold for any reason. Maybe they sold the close of 3 consecutive bear bars. Reasonable thing to do, and they're trapped on bar 4. You also have bulls who did not buy above bar 3 because gap down, 3 consecutive bear bars. Not a good buy, signal bar 3, but a good entry bar on 4. So traders are trapped, and this will probably get a second leg. And I'll mention one more thing about over here. I thought it was fairly difficult to get long because, like I mentioned earlier, bar 4, hard to buy above it after big down, big up. Maybe you buy the first reversal attempt below bar 6, bad low 1. But even still, you're still buying possibly high in a trading range. And all through here, really not good for stop orders. But anyway, so back here, the point I was getting at with that is most breakouts have pullbacks. And in this case, we had a brief pullback, and then you could say all of this was the channel, the second leg 1, pullback, leg 2. But all of this was tight enough to be a breakout on a higher time frame. So all of this will likely get a pullback, and then its own second leg. And that's what traders were looking for in the middle of the day. I think traders were hoping we'd get back here to bar 3, the bar 3 high, or even the bar 3 close. Any bear who sold the close here, hoping the market would get back here. But if you think about it, if you think in terms of disappointment, if you're a bear and you sold a close of 3, and you're thinking, this looks like a decent breakout, I'm going to go for a measured move down, and that's your entry bar, you're feeling disappointed. And if you had to choose whether the disappointment was major or minor, it's probably major. And if it's not major disappointment at this point, it certainly is somewhere along the way. But let's say you're a bear and you sell the close of 3 and you sell more below a bear bar. And let's say you don't take 6 because it's the first reversal after a pretty decent bull breakout. No trigger below 11. Let's just say you sell below 17. And that's not a great example. Ideally, there'd be something more like here. You sell more below 33 or 34. So you take the sell Using a very wide stop, knowing that if you scale in, you can probably avoid a loss, although I don't recommend trading that sort of style. Scaling in is not for fixing bad trades, but this is the logic and the theory behind it. A bear sells bar 3, they sell more below a bar like 34, and they're so disappointed in the trade, they just look to exit at break even on the entire trade. And you can see they didn't even get there in this case. And if you use the example of limit order bears, that one shows it better. Bear sells above bar 3, scales in higher, they sell more below 34, and here's their cost average, this red line. The market tests it. Bears are so disappointed, they take break even on the entire trade, and then we rally. Let me back up one more time. If you're selling and you have a stop way up here, and you're 1-to-1 risk reward from the market price to your stop. Sorry, I lost my train of thought there if I repeat myself. So here's the market price. It does not matter it doesn't matter where you sold. You could have sold the high tick up here. You could have sold the close of 42. It does not matter. It's the same trade. If you're short, you're selling on every tick. You have to be willing to sell on every tick of every bar. Open profit does not mean you have a risk-free trade. If you have an open profit, the money is in your account. And again, the risk on the trade is the distance from the market price to your stop. So you're short anywhere, and here's the current market price, let's say bar 44. You need to be 60% sure that the market's going here before here to stay in this trade. And, sell climax, bad follow through, sell climax, bad follow through, sell climax, bad follow through. That might be 3 pushes down. You may get a deeper pullback. And again, I keep bringing it up, but 50% pullback is a common support level after a rally. So if you're being fair and honest with yourself, there's probably not a 60% chance we're going here before here. Market's going more sideways, and if you're selling in a support area near 50%, the midpoint after a rally in an overall trading range day, you need momentum. And if you're going sideways, then there's too much of a risk that we break back up to the upside. So it all goes back to the trader's equation. Let's say your stop's even above 36 and you're short. And the high of bar 3, it's a reasonable target, but the price action has to cooperate, and there needs to be enough reason to stay in the trade. So again, if you have a wide stop and the market's going sideways, your risk is simply too big to be holding short when there's trap traders below. And that's why I brought up this example. A bear who sold above 3 and sold more higher, they'll just take break even on the entire trade. That's exactly what we got here. Bar 50. So because of the context, because of what we have here, around the 50% pullback of the rally, and this should get a second leg, deep pullback, 50%. Bar 50 is a reasonable stop order buy, looking for a retest of the high of the day. But the most likely outcome after this, it's sort of big down, big up, big down. It doesn't look like either side is really in control. So more likely, the market will remain sideways for the rest of the day with resistance up here and support here. Getting a bull breakout, but a bull bar followed by smaller bars. The follow through isn't great, and you have trap traders above. We can even call it the stop order above 35. A bull buys above 35, good looking bull bar, 3 legs down, and a bull trend, they get trapped. That will become resistance. We didn't quite get there here. We came close to it on 76. And what about this? What happened here? Well, let's think through major trend reversals. Here's a bear trend, and maybe we even say this is the bear trend. We have a bear channel. And the market's channeling down. We get a bear break out of the channel line, so that's parabolic, it's unsustainable. 25% chance this continues strongly to the downside. 75% chance we reverse within 5 bars and test the trend line like we did here. And then what happened? We got a trend line break. So the bulls were able to rally. We got a lot of bars completely above the moving average. That's disappointing. Think about the bears who are short down here. The market's going sideways. Look at bar 51. Is that a good stop order buy? No, not really. It's a bear bar in a tight trading range. So if you're buying here, you're buying high in a tight trading range after a sell-off above a bear bar. But it gets good follow through. So that will become support. And then again, if we think through major trend reversals, what do you get? Bear trend, trend line break. Expectation is a retest of the bear trend's extreme, so the low of this bear trend. But the expectation then is support. We have trap traders below. Bears are disappointed. Bulls are looking for a second leg after this rally. So support below. So we get bar 60. Testing near the bottom. Maybe it's the bottom of this trading range. And once again, maybe it's the 50% pullback. You can see we came close to that. Bear trend, trend line break, sharp retest, but the way this bar closed was probably a bear trap. Some unfortunate bear sold the low tick of 60, and they're obviously trapped. The market rallied above the bar's midpoint, and that's enough to get a second leg. And we may be beginning the second leg up from this rally. We'll probably go one tick above 55. Spike, deep pullback, channel. Much weaker bull trend than over here. And you can see what happened. We got one tick above 55 and then found resistance. And then really just a tight trading range here. At the end of the day, limit order market, not ideal for really any trader, but if you are trading, you're a limit order trader, you're scalping, you're buying below bars, selling above bars, and taking quick profits. But in general, and this is an idea from Ali. Ali says most traders should not be trading past bar 72. And I know that he says he stops trading by bar 72. And the way he explains that is, if you've had, there's 81 bars in the day, up to bar 72, you've had 72 bars, 72 chances to make money. And if you haven't made money at that point, then you might as well just call it a day and, come back tomorrow. Or if it's Friday, come back strong after the weekend on Monday. But this is sort of a combined no trade zone. It's late in the day and it's a really tight trading range in the middle of an overall trading range. So really not much to do here. Here's the open of the day. And the close, we closed sort of near the high. But there's a pretty prominent tail above the bar. So you can call it a bull trading range day. You can call it a bull reversal day. Here's what the day looks like on the daily chart over here. It's a bull reversal bar with a tail. For stop order trades today. Early in the day, with Al's 50% rule, 50% of breakouts on the open will fail. And you think about the context, we're trying to break below yesterday's low. It might be a big second leg down. Not ideal to sell in here. If it's going to be a big bear trend day, you'll have plenty of opportunities to sell later in the day. I mentioned bar 4 earlier. It's not the greatest trade, but you can buy above bar 4, probably always in long. But through here, not ideal for stop orders. 17, not great, because even though it might be 3 pushes in a big bear trend bar, you're selling in a tight bull channel. And this is a more parabolic wedge, which means it's minor and it's a breakout on a higher time frame. And even if it is 3 pushes, you expect a minor reversal and then continuation. 34, maybe you sell below 34. It's not great. It's really a couple of legs down, maybe low in this trading range. But if you think about the day as a whole, this probably will not be a bull trend day all day long. And if it's going to be a trading range day, we've had a couple of legs up, probably get a couple of legs down. So not the worst trade below 34. 36, 37, also okay to sell. And then through here, if you recognize where the market is, 50% of the rally, and we're getting sell climaxes with bad follow through, going sideways for a lot of bars, about 50 made a lot of sense to buy. But it's a trading range, and if you're buying, you're not expecting a bull trend. You're expecting a second leg up from this, leg 1, leg 2. But if you recognize there's trap traders here, the upside might be limited. And if the market gives you profit on a trading range day, you should probably take it, because look what happened all day long. Big bear breakout, and then reversal, and then all the way up. The bull breakouts had bad follow through. Bull breakout, big bear bar. Bull breakout, big bear bar. Bad follow through, bad follow through. And it's the same thing on the way down. Sell climax, they take profits. Sell climax, pause, sideways. So here, is this going to be the start of a big bull trend, or are the bulls who bought lower going to scalp out? Certainly no stop orders at the end of the day. There's an argument to be made about selling 59 for a retest. If you think about the major trend reversal, trend line break, retest, so maybe you take a chance. Sell below 59, your initial risk is small. Maybe you can make 2 times your initial risk on that trade. But again, at the end of the day, really no stop orders worth taking through here. And where do we go tomorrow? The market's still in a trading range. And now we have a bull reversal bar. And it might look decent because we have a rally and a couple of legs down to the moving average. But if you think about it, if you're buying above this bar, you're being forced to buy in the middle of this tight trading range. And let's think through the trader's equation. In general, you can usually think like this. In a trading range, nothing is better than 50-50. So if you're buying above this bar, stop below the bar. Sorry about that. Stop below the bar, you buy above the bar. At best, there's a 50% chance we're going here before here, and you just simply cannot take that trade with that math. I think the reality is there will be sellers above today, although maybe not directly above the high of today because it's the middle of the range. So we may have to go higher to find sellers above. And if we sell off, probably buyers below today's low. The bears, I don't think they've done enough for a major reversal at this point, but you could say there was this steep bull trend line and we're going sideways. We're breaking sideways to down, but there's just not enough bars and not enough selling pressure. We probably have to retest the highs again and go more sideways before we get any sort of major sell-off. And we might go sideways for a lot of bars here. All right, thanks everybody, and I hope everyone has a good night. Thanks for watching.